Hey, Dan Passarelli here. On Wednesday, we have the FOMC minutes. On the Wednesday, Thursday, and Friday, we have the Jackson Hole Summit, and the market is waiting for that moment of truth when we see if there's clarity as to what the Fed will do when it comes to interest rates. Well, in addition to that moment of truth, I feel like today I had sort of a moment of clarity. And that moment of clarity is, the beginning of this year, the Fed stated that they were, looking towards cutting rates and having a soft landing, and that drove the market up, up, up. But the Fed never cut rates since then. Now, obviously, the data didn't indicate that, but I wonder if the Fed sort of knew that it would be unlikely the data would indicate that, and that they could instill some confidence in the market and get the market higher. Now, that is not one of the Fed's mandates. It's not the Fed's job to make the market go higher, but it just kind of struck me kind of strange that did the Fed really think that the data was going to happen by April, as people were thinking, or July, as people were thinking after that? And maybe they did, and maybe they didn't. But what I find strange is that in order for the data to indicate that we're ready for a rate cut, which is, by the way, 77% chance of a 25 basis point in the next Fed announcement is priced in, and the rest of the people think that 50 basis points is priced in. Very, very aggressive thinking on the part of the market. So in order for that to happen, what would have to happen is that we would have to move towards a recessionary scenario, and inflation would have to go down even more than it is already. And what I think is a moment of clarity is that I have a hard time visualizing that happen. But nonetheless, the PE ratio of the S&P 500 is 29 as of today, which if you track that kind of stuff and you kind of understand what PE ratio means, price to earnings, that's one of the highest PE ratios in history, let alone the last 10 years, which means that by that metric, the market is drastically overpriced. Now, what could happen is that earnings could go up, and then that would balance out the PE ratio, and maybe people are just getting ahead of it, pricing that in. But they're looking for bad data on the economy, pushes us more towards recession. And so is the PE ratio high and people are buying stocks because they think earnings are going to be better and the economy is getting stronger? Or are they buying stocks because they think the Fed is more likely to cut rates and the economy is doing worse? These things kind of fight each other. And I guess what I think is kind of a moment of clarity is that this really doesn't make sense to me. It just doesn't make sense. Now, the tricky part is how do you play that, of course. It would be kind of crazy to just full out short the market from here. But I think any sign of weakness, any sign of pullback, I think it's very, very likely that we see a pretty aggressive move to the downside. Now, look, I'm not really in the business of prediction. You don't have to know what the market's going to do to make money trading it. But I think that's something to look towards as a signal to get short the market in the short term, not for years, but in the short term, in order to place some short delta trades when that situation plays out for some temporary period of time. So that's my thought for today, and I hope it helps. This is Dan Passarelli, Trade Smart.